Hello and welcome. This is Greg Owen, the CEO of the GoCo Group. Well, let me say, I know that there's some people around Australia who have been locked down with COVID in Melbourne and other surrounding areas in Sydney and Greater Sydney area. My thoughts go out to you. I'm also in lockdown, so I appreciate you're going through, but I know we'll be out the other side really, really soon. Hey, look, we've got a fantastic program for you today. Of course, we have Harry and Robert on the program, but we also have Sean Allison speaking. We'll have Darren Jenkins, and of course, we'll also have John Thomas. So we've got a magnificent program for you today. So make sure that you have water and coffee and everything ready wherever you are at your home, watching it on the big screen or on your computer. We've got a fantastic program. You're gonna love it. But first of all, and I'm going to go to Harry. Harry, are you there?
Good day to everybody. This is a very important time in history. I have been preaching about this since I started my research in the 1980s. We'd have this great baby boom, and then a slowdown and a big change in the economy before we go into a new era. And that got cut short by the massive stimulus of governments around the world when my predictions in 2007 peak came true and things went down. And 2008 and 9 looked just like 1930 and 31, and governments overreacted. Now, because they've overreacted, we're going to see things go the other way. I'm going to show you today, we already entered that winter season. Ask yourself, how come it has taken so much global stimulus, especially in the US and Europe, to keep our economies going for 12, 13 years now, and now we need even more after COVID? So the answer is our economic trends have been going down for all this time, and we have been stimulating to cover it up, and that is artificial. It's not real. We have a fake economy, as you've heard Robert Kiyosaki, I think, say in some of his presentations to Australia. Fake. It is totally artificial, and that creates imbalances in investments and spending that then turns the other way, and we have a deeper downturn than ever. So I'm going to show here that the downturn that started in 2008 was cut short, and we're going to have a bigger downturn to finish the process of restructuring bad debts, zombie companies, all this stuff. And so we can enter the next phase of the global boom, which for the United States and Europe will not be until 2023-24. But for Australia, which I always start my presentations to you guys as you lucky bastards, you guys have the strongest demographic trends in the developed world, one of only 4 or 5 countries, you and New Zealand, and you are the strongest in the world. So you have only your real estate excesses here to deal with, which is big, and second largest to China. But you have the best demographic trends to come out of the greatest downturn in history. And if I was a global investor instead of just a US investor, which I am, I'd be investing in 3 places after the next big crash that I'm predicting for the next 2 years: Australia, Southeast Asia, and India, in that order, with India being the strongest long-term. So Australia comes out the strongest, then Southeast Asia, but in the long term, India is the next China. Mark my words on that. Why? Because I study demographics. I study the things that are predictable long-term. And most economists just study, oh, the economy goes up and down, and here's the indicator stuff. Short-term indicators mean nothing. I always tell people, oh, think back to 1989 or 2007 or 1929. How did the economy look at the top of some of the greatest booms in history when stocks were at the highest and the economy's doing, it looks great. And then suddenly it turns. It's only a trigger from a change in trends. And what I do is measure when changes in trends are going to come in demographics, generations, spending, and not. And in every country in the world, A lot of countries are linked, especially North America and Europe. But when technologies move mainstream and peak and when they decline, these are the things that really determine real growth that is real and does not take 13 years of stimulus by governments to keep a dead economy going. And I am saying and have been saying our economy is dead, especially in North America and Europe, and Australia is not as dead, and you guys are poised to come out of this the strongest. So that's the whole point here. So if I can bring up my presentation. Again, what I'm saying, and again, I've been warning about this for years. Governments, let me summarize this very simply. We have seen a peak in demographic trends in the developed world, US, again, North America, less so in Australia, but you're 25 million people, so I can't count you that much in that. Thank God for you and for the world. And this incredible fight against that downturn since 2007 demographic trend by governments printing more and more and more and more money. I mean, I always ask people, like, don't you think it's strange that since 2008, every year governments have had to print money out of thin air just to keep the economies and growing in countries like the United States 1.6%? You know, 1.6% is the lowest recovery in all of history, and now for 12 to 13 years. And yeah, Australia has been better because you guys have stronger demographics. I'll get into that. But the global picture, US, Europe matter. Oh, Japan, what happened to Japan? Do you understand? Let me tell you one thing, why you should listen to me. 1988, 89, in my first self-published book, before anybody would listen to me at all, I said Japan was going to collapse from 1989 forward through the 1990s, a 14-year downturn, and people like laughed at me, like even these small business CEOs who were more open to what I was saying back then were like, what? Japan is rising, Asia's rising, and the US is a falling country, and Europe, and they would imply even Australia with that. And I'm like, no, our baby boom is just catching on, and it's stronger than any in the world. Yeah, Asia has one coming after, but not like this. I predicted in the mid to late 80s that we'd see the greatest boom in history. The early 90s downturn was temporary and stock crashes, and the US and Europe would lead us out of this, and that's what happened. Simple demographics. I'm not optimistic, I'm not pessimistic. By the way, people are calling me a perma-bear these days in the last several years. Look at my career. Since I started, I've been bullish the whole time until 2007. I started to get bearish, and then governments overstimulated, and then I got bullish and then bearish again because they overstimulated. So I'm not bullish or bearish. If you want to listen to somebody about the future, don't listen to anybody that's always bullish or always bearish as a bias. If you're not bullish and bearish, you're not a forecaster. You don't understand how real life works. The difference is trends are up more in modern times than down, and I'm hip to that as well. But we are in one of those down periods, and it's not going to end until about 2023 or so. And governments have pushed this recovery with so much stimulus so far, and they use COVID after that, that we're going to see a final collapse and crisis that is a good thing because it takes all the excess financial asset values and bad debts and zombie companies, flushes them out, which you have to do before you can go grow again after any boom. And that's what's going to create the next great boom. And the most important point of this presentation for the Dent Sector Fund, which is going to protect you in the downturn ahead, which most funds can only do one thing. They can only be bullish or bearish or this sector, that. No, we're every sector. We're in the sectors in my 4-season cycle of the economy over your lifetime. and bull and bear demographic markets and technology trends and stuff, we tell you to be in the sectors that are benefiting from each phase of the business cycle. That's my expertise. So that's what the Dent Sector Fund is designed to do, to put you in the best places, which in the next few years is going to be defensive, high quality bonds, things like that, that do well in a downturn, especially when all financial assets involved are collapsing. But more important for this fund and for your future out to your retirement, out in the 2020s and 30s and beyond, in the next boom from about, and I'm telling you today, and I'll show you 2023 or so into 2036, 37, and way beyond that for Australia. We're going to have you in the best sectors as the next millennial generation grows up and the baby boom ages in your country and all countries. People drive our economy. That was my breakthrough back in 1980s. Now, here's my favorite person, Leonardo da Vinci. I am not an economist. I'm an entrepreneur. I'm a creative person. This guy was everything. He was an entrepreneur. He started businesses. He was a scientist. He was an innovator in everything. And you know what his favorite phrase was? Simplicity is the ultimate sophistication. So here's the secret to life and forecasting. Life is complex. Yes, that complexity plays out in the short term where there's infinitely more cycles in politics and everything. But in the long term, the smartest people, like Da Vinci, have seen, no, trends are very simple. The most important trends that you can use to plan your life for the rest of your life are simple and projectable. So my promise to you, like him, what can I do for you? You can see the key economic trends that will impact your life, your business, your investments, and your family over the rest of your lifetime. And I go past that with my forecasting tool over your kids' lifetime. Now, not short term, up and down, but yes, when should you invest in the economy up and down? When should you be in real estate, different sectors of real estate? When should your kids go into the workforce or be better off in school? I'm telling you, everything. This is something that's never happened before, and I only stumbled onto it, okay? Stumbled onto it because I was consulting to real businesses, Fortune 100 at first, seeing the old economy fading, and then new businesses where I was more interested in the new economy, early stages growing rapidly and emerging. So I saw the whole business cycle, 4 stages, spring, summer, fall, winter, S curves. I learned so much in a matter of years, and I've applied that to the economy ever since. I took the micro patterns in business and developed a new economic theory. This is especially critical, the last sentence, in an unprecedented economic explosion wherein more progress has been made in the last 120 years than all of human history. And you know what? My biggest cycle, I'm a cycle guy, you'll see, 500-year cycle. This cycle, we're only halfway through it. The explosion since the late 1800s into now will continue into the mid-2100s, 2140 or so. I can tell you that today. It's not going to look like that in the next several years, and it's going to be slow to recover at first. Your kids and grandkids will see this, and you should help them understand that as well. So here was my first simple indicator. Simple. The spending wave. My research for the small businesses in the new baby boomers that were buying their products instead of the aging Bob Hopers, I found a new source of information from the Bureau of Labor, the US government. They charted spending by age and have done it every year since. They showed me that the average person enters the workforce around 18 to 20 and spends the most money, 46. Now it's a little later for the millennials. When I was growing up, and then spends less the rest of their life. And so here was the first indicator I had called the spending wave. I move forward. Now, think how simple this is. Spending of a new generation, like the massive baby boom in the middle of this chart, forward 46 years from the birth index. And I had to eventually, in not too long, I've adjust it for the immigrants, which I can also do scientifically down to the year of when they're going to peak in spending as well. Look at this. Okay, yeah, there's up and downs, but Bob Hope generation peaks in 65 to 68, declines in the early 80s, and then the baby boom into 2007 or 8, and then starts to decline. And that's the secret here. People keep asking me and other economists, why has it taken endless stimulus to keep our economy barely growing? Again, you got to think back from Australia. You're a little stronger, but in the US and Europe, the greatest countries in the world, and even in China, in Japan, and South Korea that are declining. Why has it taken so much stimulus? It's because they're countering this downturn, particularly in the leading country, the US, North America, from 2008 into 2023. And we're at the bottom of this now, and I'll show you later how overvalued the stock market is compared. But this indicator was my first breakthrough in 1988, and people laughed at me when I put this out, but a few years later, they did not. This is the most fundamental. People drive our economy in developed countries with good infrastructures and democratic governments, not in terrible countries and stuff, which we know and stuff, or third world countries. Although to a large degree, this is true in most of the developing countries. This is what drives our economy. This is the fundamental trend, and it's not just that they enter the workforce after costing the economy tons of money, which causes inflation. But they also innovate when they're young and bring those new technologies when they grow up and adopt these products. And the new technologies augments their spending power as they naturally earn and spend more because they age and get smarter and have to raise their kids. What is more important than this? I would say nothing in today's maturing global developed country economy. And again, this did not come out of a theory. I started charting this in 1981. Actual facts. This is the average spending cycle of the average person in North America. And I wish I had this in Australia as exact or Europe, but I don't. But I can tell you, it ain't much different, if any. People are the same in most of the developed countries. Into the workforce, as I said, 18 to 20, massive rise into the 30s, and then peak 46 for the baby boom generation. This is now 47 if I put this graph today for the millennials, but the last boom we've seen decline. 46, the peak in spending. Oh, what's that last little vestige into 54? That's the more affluent people that go to school later, peak in spending later, okay, and have kids later, all that sort of stuff. But the peak is 46, but the important point after 54, massive decline. Once a generation peaks in spending and then plateaus, there's a really strong decline, which takes the next generation to offset that. And if there's not a bigger one, which is like now, doesn't happen fully. Now, here's the good news for you. I just showed you the baby boom in the US, up and down, and the millennials barely come back to where they are, then go down again. Oh, here's Australia. Oh, you lucky bastards, you. Oh, you're not having babies any more than we are. No, you have the best train of immigrants from the best immigrant source countries in the world. So in the US, we get immigrants, which augment us to some degree, but they tend to be lower income and productivity on average. You're getting the highest income immigrants with higher productivity from Asia. So your spending wave not only declines a little bit in 2020 to 25 in this period, slightly, so a little bit of downside, but it keeps going up. And if these immigration trends continue, it goes up forever. I mean, my God, you are the best place to live in the world. Oh, let me just quote something here. I just saw this art. Now, I've been saying this. I've been lecturing to Australia and New Zealand, but more Australia for like 20 years. A lot because of GoCo and Greg Owen and now Andrew Stewart and this fund. There was a recent article from International Living, the best source for kind of upscale people. 10 best cities to live in. Guess what number one is? Oh, you're going to be disappointed. Not Australia. Auckland. Number two, Osaka, Japan. 3, Adelaide. Adelaide was number 3 in the world. I would not rate that, but I'm not, I like, the bigger cities. Wellington, New Zealand, number 4. Tokyo, number 5. Perth, number 6. Australia again. Zurich, Switzerland. Geneva, Switzerland. Melbourne, and Brisbane. Now, I'm asking at this list, where the hell is Sydney? Because that's my favorite city. It's just my bias. The harbor, the views, everything, the climate in between Brisbane and whatever. I don't live there, so I'm not the best source, but I would pick Sydney as number 1. But okay, out of the 10 best cities in the world, how many are in North America? 0. How many in Europe? 2. Only in Switzerland. Do you think Switzerland considers themselves a part of Europe? They are, way above that. 4 in Australia, 2 in New Zealand. You lucky bastards. Okay, but you're not only doing well, you're going to keep doing better with these types of demographics. The spending wave is the best single predictor once countries get developed and have good infrastructures. And Australia is the best in the developed world, followed by Norway, Sweden, New Zealand, and a few other countries. Everybody else is going sideways, like the US or the UK, and the rest, like Europe and East Asia, down forever. Okay. Now, when you get major booms and busts, you get deleveraging in debt and financial assets. We see the last great deleveraging was 1929 peak in this chart with the red circle on the upper left. And then debt, 60% private debt in the United States disappeared. Now, that's painful. High unemployment, business failures, bank failures. But for the economy long term, yeah, this is like taking a big dump. I hate to say it. It's just like you get the bad stuff out of the economy and you free it to grow more. That is the natural cycle. Grow, let a lot of flowers boom, and then you weed out the losers, and then you grow again with new innovations. That's what's necessary for economies to grow. But you can see on the far right upper here, oh, we had this second great peak in innovation and debt and stuff. And oh no, the debt didn't go down that much, and now it's going back up again. Oh, we didn't deleverage the debt. Oh, so this is why we're not growing yet, because we didn't let the economy do what it does best, grow and then flush out the excess. That's what natural economies and excesses and all of nature does. Now, so if we look at this on a global basis, this is the most important chart, maybe, in this presentation. Remember this number. Globally, it's 65 trillion in the US, 525 trillion globally in financial assets, which have blossomed up in the greatest boom in history since the early 80s. You know what happens when these financial bubbles, and they always do, deleverage and get out the bad debts and bad financial assets and financial values of bubbles? 40, maybe even 50%. I'm just looking at 40% here. Out of $525 trillion in assets. Now, let me put that in context. That is 6 times the 80 to 85 trillion global GDP. 6 times when it normally would be 2, maybe 3. And then 225 trillion or so, 3 times almost GDP globally, disappears. Do you think that would hurt if 40% of the wealth in your brokerage accounts, and not forget your savings and banking account and your bills, your brokerage accounts and your wealth and your housing and the stuff suddenly lost 40, maybe 50% of value? Would you feel poor? Would you spend less? Would you be pissed off and maybe storm some capital? I think so. You judge. That's what I see coming. This is once in a lifetime, or even a little more, every 90 years by my best cycles. Now, so since this has started happening since 2008, look at what central banks, this is all the major central banks, not Australia, we could add you in, but they've been going straight up. They've been printing money to offset this demographic downturn in the developed world. And now look at since COVID here at the far right. Massive. COVID gave central banks, and on top of that, governments, the impulse, the excuse to not only print far more money than they've already been printing forever, which is unprecedented and is something for nothing, which could not possibly succeed long-term economics, by my estimates, and then add even more monetary and fiscal stimulus on top of that. For the US alone, since just before the COVID crisis and the repo crisis in banks in the US in late 2019, into the year and a half after that, 65% of GDP pledged monetary and fiscal for stimulus. 65% of GDP to keep an economy that's only been growing since 2008, 1.6% per year for 13 years. And now, oh yes, we got more short term because the COVID recovery, but forget that. Everybody knows that's going to pay. To maybe keep it growing at that, maybe in the future, 65% of GDP. If you had a business and they said you have to borrow or raise 65% of the value of your entire business for all the future just to grow at 2% next year, would you take that bargain? Okay, if you're not a business person, that doesn't work, but if you are, it will work. Okay, so what has happened? As usual, look at this. As the printing grows, the central banks keep doing more. And after this downturn, look at this yellow line, they followed, the stock market followed the yellow line, the blue line, and went straight up. Stock markets are only going up because governments are printing money, not because the economy's sound, not because real profits are that strong, because there wouldn't be real profits without a slower economy and unbelievably low interest rates, below market rates. An idiot can make money in this economy, okay? It's not a good economy. It's not good for the future because the economy grows by weeding out idiots and rewarding people that are doing the right thing. That's called free market capitalism. I know I'm sounding like an old timer now because that's an ancient term, free market capitalism, because it's been destroyed here. It's going to come back because that's the real trend. Real people growing in demographic trends, investing real efforts and investments in new technologies that create real growth and real productivity instead of printing money to cover over a 13-year downturn. Believe what you want. Now, here's my most important summary of everything I've done in my research. Demographic trends up and down about every 40 years. That's the blue cycle here. Inflation, modest in the spring boom, high in the summer inflation. Why would inflation be high when the economy's in a downturn from the Bob Hope generation because the larger baby boom entered, young and expensive. Young people cost everything and produce nothing. Young people cause inflation. Middle-aged people cause a boom with low inflation. Older people do what? Slow down and die. That's deflationary. Sorry, I'm an old person. I'm 68, okay? I understand this, okay? We're in denial of, we think, the aging of almost all the developed countries in the world is going to end up in higher inflation or higher growth in the future. No possible way, end of story. Unless there's some great innovation that causes us to suddenly live 20 years longer and, I don't know, stronger sex organs, a lot more productivity. That could happen. I'll tell you when I see that. Don't see it yet. This is the primary cycle. Where are we in this cycle? We entered the fall boom peak in 2007, as I predicted decades before that, with the baby boom peak in the US and Europe and most developed countries in the world. And we started to go down in the winter season in 2008, 9, and oh, the government say, oh, we can't have a depression like the 1930s. So we're just going to print trillions and trillions and trillions and trillions and trillions beyond that of money to heat up the winter season. Oh, they don't understand. The winter season's about the great fall bubble boom, causing great innovations and new growth businesses, and then shaking out the ones that did not work out so well to clear the ways for those people to be the next leaders, like the auto companies coming out of the Great Depression, and now the crypto companies that could come out of this. I understand the economy because I grew up consulting to not only Fortune 100 companies, but small new ventures. And the new ventures are the ones that really create the future. And the large companies are the fading of the past. Both of them interact in this four-season cycle. That's simple. Economists do not understand this because they never started or run a business. How many economists you know run a business? I would add to that, how many look like they might have had sex at some time in their life? So I know they have, but they don't look like they have, okay? If you don't understand sex and business, you don't understand the economy. This is the cycle that everybody goes through in their 80-year average life cycle, and businesses do, and shorter and longer. And economies around our demographics go through this cycle. We've been in the winter season since 2008, but governments have been in denial about it and did not allow, like in the early 30s, this restructuring of debt and economy. So we're still carrying all these zombie companies in debt, and we're trying to crawl into the next spring boom, which we haven't come to next 2023 forward, and we won't do it until we do. That's why I welcome a downturn. I know it sounds perverted. Now, I started in the middle here in these four cycles. This is my hierarchy. Now, this is important because I will tell you where I learned the most about forecasting. From economists, no, they're horrible. Always have been, always will be. Never had sex, never run a business, just for the start. Scientists look at the longest term data and have the longest term trends, and oh my God, are they so good at cycles. You can't talk to a scientist without talking about 100-year, 1,000 years, or 5,000 year cycle. I mean, they have this stuff down. I mean, that's the way life goes. Well, in this time frame of modern history, in 30 to 40 years of research, I've come up with this singular model, which is the best I've seen anywhere, only because I couldn't find anything better. And the top line is the most important cycle. I talked about demographics. I showed you that, boom and bust cycle with generation. No, the most important cycle for productivity long-term is new technologies that change how we can work and do business, and new technologies and new industries and stuff. That's the biggest stuff. The next strong one that's the black line, is the 40-year approximately generation cycle. 1929, 1968, 2007, 39 years, really close to 40, okay? I also early on detected a geopolitical cycle where, things are just difficult, wars and conflicts globally, and then not. Well, we've just had one of those difficult cycles. We're about to come into a good one, just as all these other three big cycles are about to turn up. So these four cycles are my map of the future and why I can tell you and your kids and maybe your grandkids what the future is going to look like macroeconomically in any major country and in the general economy out for decades and decades. This sounds preposterous, but if you talk to a scientist that looks at repeating cycles in climate and everything else, it would be, oh no, of course. So I'm a scientist, not an economist. And I would hope lucky for you. Now, the bottom cycle here is a decennial cycle. Ned Davis came up with this before I did. Thank God, I love this guy. He showed back since 1900 that most of the major recessions and downturns in stock markets comes in the first 2 to 3 years of every decade. Okay. How long have you lived? 60 to 62, 70 to 72, 80 to 82, 90 to 92, 2000, 2002, and now 2020 to 22. But again, in this one, since things started to get so nasty in 2020, governments pushed harder. So it looks like, oh, we're out of this. No, 2022 is still the mark. I have been projecting since the 1980s when I started writing books, projecting the future, that late 2022 on all of these cycles would be the worst downturn, especially for stocks and economy on a lag in 2023 in our lifetime. I still think this is coming. It may be pushed out a little bit because of all the stimulus, but not that far. Man-made central bankers who've never had sex and never run a business have no chance of beating the natural cycles of all the consumers and all the businesses in the world that are smarter than them. The collective consciousness of all human beings is bigger than a few fearful economists and politicians that don't want to have a recession. Oh, look at this green cycle at the bottom. We have major recessions every 10 years. Forever. So is there something wrong with God and nature? No. Recessions clean out the bad stuff after a boom. Booms, again, let the flowers bloom and then let the failures shake out. That's how we actually grow through all of history. Whether there was modern technology or not, animals or humans, this has been forever. These central bankers, I'm going to refrain a few words here. I could say more about them. Have no idea what they're doing. And they call this an experiment. It is an experiment and it's going to fail. Now, we also have, therefore, on these four cycles, remember I said the most important was 45-year technology cycle. Every other technology cycle, well, first of all, remember that graph I showed? Every other demographic cycle, we have an 80-year, four-stage cycle. Every 90 years, we have two 45-year cycles similar. And that is what most drives technology and bubbles. It's the new industries like crypto emerging now, or the dot-coms in the late 90s, and the automobile companies in the early 1920s and stuff. These are the things that cause bubbles, industries that are just going to change everything and grow at exponential rates of 90-year cycle. Now, this cycle I discovered early in my career. So did Robert Prechter, James Dale Davidson, if you know those people. I still follow Robert Prechter closely. James Dale Davidson got a little, whatever, off track, but this is real history here. The greatest bubbles and the greatest depressions, not recessions, not even deep recession, come every 90 years, 1839 to 42, 43, 1929 to 32, 33, and now 2020, which we started last year, into late 2022 and 2023 for the economy. I still think that's going to happen. And if it doesn't happen, it just means it's going to happen later, because there's no way any artificial government stimulus forces can offset these massive demographic and technology forces that cause these real long-term trends. And again, what I say, every 40 years, we've seen the major bottoms of the stock market. 1942, after the Great Depression. Yeah, the big crash was 32, but it didn't bottom until 42 and turn up for many years. And then the Bob Hope generation peaked in 68 and then bottom in 82. Baby boom, 2007, bottom due still late 2020. 40-year and 20-year cycle. So, real quick, we have the greatest confluence of cycles in history since late 1982, and maybe 42 and 32, although 32 did not have as big a confluence as 82 now, hitting in late 2022. Do you want to bet against that? I say no. Time to get out of stocks and real estate in most countries and most markets in the world. And then if I'm wrong, they go up a little more, but if I'm right, you're going to buy way cheaper the next few years. And again, what do we have here? We've been this is a bubble boom. The 1942 to 68 spring boom in global economies led by the US. No bubbles and only 20% correction. Look at this boom. 1987, first bubble. Oh my God. And then 40% correction in a few weeks, 2 months max, but 2 weeks most of that. Oh, welcome to the bubble boom. And then, the 2000 tech bubble, 78% crash in tech stocks, 39% in the S&P. Then the 2007 minor bubble, 54% crash in the S&P. And now the bubble of all bubbles, and this is all bubbles around the world, stock markets, real estate, everything about to crash. Lower lows, I'm projecting down 85%. And people tell me, Harry, but stocks are not as overvalued as they were in 2000. Now, that was the most overvalued by far in history by Robert Shiller's cyclically adjusted PE ratios. And I said, well, wait a minute. When that peak in early 2000 was happening, the economy was growing 4 to 5%. It's only been growing 2% or so in this last 10-year boom. So he uses 10-year cyclical averages. I'm like, if I adjust his own indicator for 10-year cyclical PE ratios, earnings, which has made his the best indicator in the world, great breakthrough, and I love Robert Shiller, one of the few economists I do. I adjusted the other way for the economic growth, GDP growth. My new indicator shows we are far more overvalued than 2007 and even 2000. And remember that first indicator I showed at the first of the presentations? Here's the spinning wave. I would have never projected this back then. I would have never thought this was possible. Look at the stock market in red, the yellow shading, above the blue fundamental generational boom and bust cycle of rising spending and productivity and technology. The stock market today is overvalued by about 120%. In other words, it's at 34 to 35,000 Dow. When this blue fundamental indicator, there's no better, if you got a better indicator than this, I want to see it. I would adopt it, pay for it, whatever. This is the best fundamental indicator I've found in my entire career for the economy over time. It says the Dow should be at 12,000 a day at the bottom of the baby boom echo bust cycle down before the millennial generation comes along and raises us again, and never to the heights we saw before. That's reality. Now, somebody say, how could that happen? I will tell you, there's many things, but I can give you one indicator that shows why we're this much overvalued. This indicator shows total corporate profits in the US, supporting the S&P 500 generally, the blue line, and then the black line is earnings per share of stocks in the S&P 500. Oh, it's gone higher over time and much higher in recent years. Earnings per share. How does that happen? Oh, when governments make money cheap and print tons of money, even though the economy is not growing as fast as it used to, these companies buy back their own stock. Yeah. You want a fake economy? This is it. Okay, I'm going to go past Robert Kiyosaki here. He says, fake GDP, I agree, check. Fake earnings off of fake GDP, check. Earnings per share, double check. The stock, the number of stocks in most countries has been declining at the speed of light with buyback. Do you want to bet on this? Be my guest. Now, so let's get down to reality. Where are things going? I love long-term charts. I didn't start as a chartist. I started as a business consultant, charting demographic and technological and business cycle, four-stage cycle trends from Bain & Company, large companies to small companies. I started as that, but then I learned to start seeing, oh, the stock market reflects these in these charts, and it gets more over and undervalued. But I've studied, you find somebody studied stock market charts more than me, I'd like to meet them. And if they do, I at least have a wife, and they probably don't, okay? Look at the last major boom here on the left side of this chart. Started back in 42 in real stock prices. I'm not showing that, but started to peak in 65 with the Bob Hope generation, 44-year lag there, peak spending, and then a second peak in 68, 44-year lag on 24, the second peak in births, slightly lower, but higher productivity. And then the big, this economy started going down into the early 70s, and stocks started to crash, and then stimulus, and we had one more slight new high from stimulus. And then what? The worst crash, 73, 74 on the bottom, nominally in the stock market there. A, peak, B, bottom, C, slightly newer high, D, lower low, E, slightly new higher, final crash low. This megaphone pattern here is important because people don't see it. Most analysts like me that study charts don't see it because it only happens at the end of long 30, 40, 50-year generational type of trends. So they don't happen that often. They happen when the stock market still has upward momentum only from investors' perceptions because it's always gone up and you buy on dips, but the fundamental trends start to weaken, and that's why you get slightly higher highs but lower lows. The lower lows are telling you, wake up, the economy's failing, even though your impulses tell you as a dumbass investor, sorry, that things are going to go up forever, which they never do. This is the bigger chart of this. I'll show you another one. 2000 peak, the first tech bubble. Remember I talked about that? And then a crash, 30-some%. And then a higher high, 2000, and then a bigger crash. And then now this higher high and a bigger crash coming down to like 5,000 on the Dow. That's 85% down. These patterns, I've never seen a megaphone pattern of this magnitude, and there are few, like I said, fail. This says within months or a few years, in this case, this is a bigger pattern, in a few years, the Dow's going to be at 5,000, give or take. Maybe it's 4, maybe it's 7. Would you expect that? Would anybody in economics tell you that? No. That's why it pays to look at longer term trends and things like chart pattern. Here's the China stock market. This is the largest growth country in the world, the greatest growth, and the second largest country in the world, China. China already peaked in 2007 with all their overbuilding and overstimulating. I mean, the most overstimulated. There is no economy in history of this size is going to measure up to China in overspending. They didn't print money, they printed condos. They just built stuff for nobody. That's the worst for business because it creates overcapacity, which then creates collapsing prices and profit losses for developers and homeowners and stuff. Oh, it's terrible. So this also shows a very bearish pattern into the next couple of years. Here's the shorter term pattern. This is the most important for investors today. Starting in 2018, peak, and then a minor crash. Oh, and then early 2020, higher peak, bigger crash, sharper COVID, but that probably would have happened even without COVID. And now we're in the final wave up. Now, a megaphone pattern has these three tops before the final damaging bottom, but the final top almost always has a throw over or overthrow rally, depending on what language you speak for economists. That's what this looks like here. I would say this chart says, not within a matter, remember the first chart I showed you, over 20 years, over a couple of years, a major crash. This is a shorter term 3-year megaphone pattern that says within 2 to 3 months, if we cross back below this top line up here, we could be at 2050, 2100 in the S&P, 50 to 53% down in a few months. Now, let me ask you this. Everybody keeps telling me, Harry, you don't understand. Government's going to keep printing money and they're going to keep doing it. I'm like, I don't disagree. They've been doubling down so long, they have no other choice. When you double down and double down, as soon as you don't double down, the leverage goes against you and you die. So they're going to keep doing this. What happens when after 65%, far greater than any stimulus program over the last 13 years, comes due to COVID, and by early 2022, if not earlier by my forecast, the economy weakens again after 65% of GDP. Would that make not the dumbest person wake up and say something's wrong here? That's my forecast. It's not because the government stopped printing money. They're not going to stop. It's because the economy keeps failing and going to lower lows despite exponentially higher stimulus. What would that tell anybody? Well, it takes a few cycles. I get that. It takes me a few cycles in my life to realize I have cycles in my life, This is the death knell. That's my forecast. Believe it or not, I'm saying by late 2022 or 23, we're going to see the greatest crash in our lifetime. And this first crash, over 50% in just 2 to 3 months, is going to be the first crash down to 70 to 90% down, like the 1929 to 32 crash, which was the last 90-year cycle, which the last time all of these big cycles, 40 and 20 and stuff, largely came together, and more so this time, not less, more so. Again, you want to listen to economists that say, well, governments will do this. I know we're in a enlightened new time. Be my guest. I'm betting on real cycles and real economics. Demographics are down and not to turn down until up again until 2023 to 24. And in some countries, never again. Japan to lots of Southern Europe. The technology cycle, the most overarching, that 45-year, peaked later than the demographic, and those caused bubbles, and that peaked in late 2019, early 2020. Should have been crashing. Oh no, but massive stimulus because of COVID. I am betting that these douchebag, pardon my French, economists who've never had sex or appear not to, and certainly never run a business, do not understand the natural dynamics of this economy and think they can play God and create an economy that grows at 3 to 4% a year with 0 to 2% inflation and never has a recession. Sounds like heaven. Now, I think there's heaven, just not on this earth. So you make your decision here. What happens when we have a major downturn in deflation of financial bubbles, as started to happen in 2008 to 9, which was the beginning of the winter season and deflation of financial assets and debt? Well, what did well? One thing, treasury bonds. The longest term treasury bonds went up the most, up near 40%, while stocks went down 56%. But that was just the first crash. And again, governments, that would have been like 29 to 32 in natural cycles. Governments stopped that cycle from deleveraging and pumped us up again, so that we're going to have the bigger cycle this time. So again, what do you buy here? You buy 30-year treasury bonds. Listen to me. You do not buy gold. Gold may go up a little bit in the early stages, as it did in 2008, and it did. It will crash as it did when the crisis hits and Lehman Brothers and financial institutions after that. Gold went down, by the way, like third quarter of 2008, 33% in 2 months after edging up into the downturn. Gold is not the worst place to be, but the best place to be by far is 10 and 30-year treasury bonds. And I like the 30-year treasury bonds and the 20-year AAA equivalents. And I have been projecting since the 1980s that on demographics, interest rates peaked in the late 70s, early 80s, would come down with the productivity and aging of the baby boom to its lowest point. I predicted decades ago, late 2022. And the stock market as well. If bonds are going to be down, treasury bonds at the lowest rates as the safe haven when stocks are at their worst, like in the early 1930s or in late 2008. Okay. So what does this mean? The biggest gains from 30-year treasury bonds, zero coupons, even more, or in Australia, your longest term government bonds. But remember, when the crap hits the fan, the U.S. Treasury bonds and the U.S. dollar are going to go up the most, as they did. Look back in Australia, 2008. Your bonds did well, government bonds in the end, but they got trumped by the U.S. Treasuries in between. So you best be best in the Treasuries at first in the U.S. and then convert to Australian bonds. You're going to come out of this downturn stronger, and we're going to come out weaker. And again, cryptocurrency. I'm not going to talk about it long. We're in the baby bubble like the dot-coms in the late 90s. There's a big crash coming. Bitcoin's going to go down a lot, and then crypto is going to grow again in the next boom from 2023 to 2037 or so. Okay? This is not the time to be stepping into this. Bitcoin's a little bit undervalued on the best model in the industry, which I've studied and dipped, and it's as good as it gets for an early stage industry, but still young. We could go up one more time, but that's it. And look at this bottom chart. Bitcoin's very oversold right now in mid-2021 and could have one more run up, but it's going to go down and crash again when it hits this higher 100,000 or so level. 85 to 115, I'm saying. And again, here we go. When Bitcoin gets oversold, it bounces, but then it goes back down again. So I'm looking at, for Bitcoin, some people say it peaked to 65,000, near that. I thought that at first, but when I saw it hold here and get extremely oversold, I thought, no, the odds are it's going to have one more run up, but Bitcoin has a very clear 4-year cycle, late 2021. I don't know where Bitcoin's going to go. I'm giving you my best forecast if it breaks up above 41,000, but if it, wherever it is at the end of this year, I would sell it. And if it doesn't break up above 41, 42,000 pretty soon, I would get out of it as well. And if it breaks much below 30,000 where it is right now, I'd get out of it. Bitcoin is the most volatile asset, and it's going to go very low before it goes higher as the .com. Real estate, dyers and buyers, my best innovation. I'm not going to belabor on this. US, maybe it's slightly higher prices, but compared to fundamental demand, the most overvalued in history, we're going to see a bigger collapse than we saw, 34%. Australia is more overvalued than ever. And due to your better demographics, not as big a crash in the US, but you have to realize Australia is one of the most overvalued markets in the world. And again, we look at this best case scenario in Australia, not as bad as the US, but stock's going to go down. And in the next boom, it's India and Southeast Asia they're going to trump. That is where the strongest high productivity. I have to look at demographics and where the most productive nations are. I'm just telling you, after this crash, Australia, New Zealand, and the developed world, but more so Southeast Asia, moving to India, are the growth areas of the world. China's already peaked more than people think. You're in the best place in the world, and that's where the Dent sector fund is going to be investing. My short-term indicators, this is the best one I have, is saying we are not just at a short-term peak, we may be at a long-term peak compared to 2007, 2000, right now, or very soon. And the Schiller indicator, which is the best long-term indicator, is at its second highest valuation since the tech peak, and also due for a peak anytime. So time to get out of stocks, get into defensive investments. But remember, the whole purpose of this Dent sector fund started only in Australia at first, because that's where we could get acceptance from GoCo and Andrew Stewart. That's where we could get somebody. What I am doing here is not the normal procedure for funds, okay? Oh, you're supposed to be large cap only, small cap only, bonds only, high-end bonds, junk bonds, whatever. No, this fund goes where the seasons of the economy goes, demographics, technologies, interest rates, things I have spent my life mapping out better than anybody else. And if you have somebody better than me, I'm happy to meet them, hire them, or kill them if I have to, okay? So this is what this fund's about. We are going to be defensive starting about now into the next few years, being more into those safe bonds, which are not just like being in cash when stocks go down. They will make money, 30, 40%, as I showed earlier. In the next boom, more importantly, the biggest charter of this fund is long-term to have you in the next global boom to be in the best sectors, because you have to realize 1983 to 2007, the last great global boom, everything went up. Emerging, developed countries, all developed countries, almost all emerging. That's not going to be the same next time. Emerging countries are going to dominate, and only select developed countries like Australia and New Zealand. So that's where the fund's going to be. The new funds have to be selective in the next boom and have to protect you in the worst downturn of our lifetime. If you don't trust us all together, and I wouldn't advise that anybody put everything in this fund, obviously not. Put some money in this fund now, because the best reward is going to be in that first 50% crash that happens when most bubbles burst. We protect you there and then play the downturn from there. But most importantly, by 2023, we have you positioned not only in Australia, but more so in Southeast Asia and India for the next great global boom, which will be like China was. Imagine if you'd have seen China in the early 1980s. That's what we look to do. So, dentsectorfund.com. You want to get on my newsletter to keep in touch with me? harrydent.com, free newsletter. So, thanks for listening. I have been speaking in Australia through GoCo for almost 2 decades now. And the best investment manager we have found to promote, and we have been promoting in our tours for many, many years now, is Sean Allison. It's just simple. He has what I've been preaching in a volatile bubble and burst economy for many, many years now, a system for people to make money in up and down markets. He's been training people to do this and become their own investors for many years with great success. And I'm telling you, almost no complaint. I've never referred people to anybody in my career and not had complaints, and I've had almost none with Sean. So, but he is now developing a system where he can give people real targets for when to buy certain investments and stocks and things to, again, to grow in up markets, which we're still in slightly, in down markets. So I'm telling people, yes, you have your normal asset allocation programs with your financial advisor and stuff, but I'm telling you more and more, not only should you listen to me and get more defensive, you should put more and more, at least a good sliver of your portfolio with somebody like Sean, who, again, has a proven track record of this. I would not recommend somebody that didn't, who can maneuver you through these up and down things, and then you can allocate more if it's doing well. It's that simple. But listen to Sean, and I'm telling you, I don't know a better place you can put the first part of your portfolio for this downturn other than the treasury bonds I've been recommending. And that's more blasé compared to what he did.
Okay, thank you, Sean, for that. Now, the man we've all been waiting for, Robert Kiyosaki. Let me say, this man is a giant in the financial services industry, business entrepreneur industry. He's an absolute giant. He is the biggest seller in history in his genre. Now, that is all he needs on his CV. That is outstanding. So look, it gives me great pleasure to call in Robert Kiyosaki. And I want to say to Robert, because I know he's standing by, Robert, if you were part of the British colony, I think they would call you Sir Robert Kiyosaki. But you happen to be an American, so we can't quite give that to you, because what you've done to the financial services industry is massive. And I'm sure the Queen would have knighted you by now.
I hope not. But anyway.
Anyway, Robert, we look forward to hearing from you once again. And thank you so much for making yourself available for us here in Australia.
Thank you. Well, you know, Aussie. So I always say, I've been going to Aussie since '76. And I love your country. I went there to play rugby union, and I fell in love with your team, the Wallabies, and the guys like Ken Peasy and Far Jones and those guys. They were my heroes.
Well, thank you, Robert. Over to you.
Well, I should give a little bit of my background as to why I'm speaking to you today. And I always find it kind of surprising that people think I know what I'm talking about, because my background, I didn't go to business school. I went to military school. And when I was in military school in New York, military education is different than what I call snowflake education. And snowflake education is, politically correct and all this. But when I was at military school in the 60s, my economics teacher had us read Karl Marx, Hitler, Mein Kampf, as well as Mao Zedong. So that was in the 60s. And then in 1972, I was flying for the US Marine Corps off of Vietnam. I went from military school into the Marine Corps, Pensacola, Florida, to Camp Pendleton, California, and then straight to Vietnam. So a lot of my education came from what I read about in military school, and then I flew a helicopter gunship, and I was flying along the beach, first time ever flying over Vietnam. I'd been to Vietnam before, but now I was a pilot flying over there in a gunship. I had rockets and machine guns on my aircraft, but I could actually see what I was being taught in real life about Karl Marx and the Communist Manifesto and all those things. So that kind of changed the way I look at the world. So today, when people are saying what's happening to the world, I'm not politically correct when I say Marxism has taken over our educational system. And so that's the story of Rich Dad, Poor Dad. My poor dad was a PhD from Stanford, University of Chicago, and Northwestern, very good man, but he didn't know he had been fed Marxist ideas. Whereas my rich dad, he didn't go to school, so he thought like a capitalist. So the story of Rich Dad, Poor Dad is really the story of a Marxist versus a capitalist. They're both good men. And I'm not against Marxism. I'm not politically, I don't really, not political at all. But my concern is that our freedoms are being taken away. And when I was in Vietnam as a Marine Corps pilot, I fought for the freedom of speech. And in America, the freedom to bear arms. And now the academic elite is coming, like the Clintons and Obamas are coming after us. So, President Trump's a really good friend of mine. I know he's not popular, but he's a good friend of mine. We wrote 2 books together and they shut him down. I've been shut down on YouTube and on Facebook. And so the reason I say and I do what I do is I fight for our freedoms. So if you want to be a Marxist, you want to be Muslim, you want to be a Christian, that's up to you. That's not what I'm here to do. But just leave our freedoms alone. And for those who have read Rich Dad, Poor Dad, one of my first questions I always ask is, why don't we teach money at school? That's my whole concern. Because one of the ways Marxists or communists or socialists control you is via our money, government money. And today in America, the biggest challenge facing us is not Iran or Iraq or Afghanistan, is our entitlement programs. Our entitlement programs are eating us alive, which is causing the debt of the United States to go through the roof. So every time I said things like that, I got in trouble by the people who are socialists, like the Clintons and Obamas and all that stuff. He said, how dare you? You're cruel to people. I said, I'm not being cruel. I just want to know, why don't we teach people about money? So really, that's kind of my background. And it's getting worse, unfortunately. So the reason I like speaking with Harry Dent is Harry Dent and I agree on something, that it's going to get worse. So this just came out here. It's The Economist. And this is the fault lines in the world economy. It's July 2021. And that is kind of my study. I'm not political, nothing like that, but I do study the macroeconomics of the world. So Harry Dent and I do say the crash is imminent. And our solutions are different. And so that's what I could talk about today. What Harry would do, I wouldn't do. But the cause of the crash are the same. So that's basically why I speak and why I write. Is I remember flying my helicopter with my rockets and guns and escorting a troop transport helicopter up the beach to Hue, city of Hue, in 1972. And I saw these French villas, because Vietnam was the French Indochina villa, or the Paris of France, or what they call it. But these beautiful, beautiful French villas were all bombed out. And my question is that the future of America or Australia? In world history, the Marxists and socialists have murdered 120 million people. And my concern is that might be repeating soon. So I hate to be an alarmist and all this, but my talk today is about what I did to protect myself from what's coming, this thing here, the fault lines in the economy, but also to teach. So I've been teaching for 25 years for Rich Dad and Poor Dad. Question again is, why don't our schools teach us about money? It's not a mistake. It's part of Marxism.
Thank you, Robert. Now, Robert, some of the questions I wanted to ask you was that 12 months ago, you were sharing with us about a number of things, and we talked about the Great Depression ahead. And of course, the last 12 months with COVID, we were all unsure what was going to transpire.
Right.
And a lot's happened in 12 months, as you can see. But do you still see now that there's going to be the Great Depression ahead?
Like I said, Harry Dent is a good friend of mine. He and I see the problem, but we disagree on not disagree, but we have different solutions. So he and I hope it doesn't come. But like I said, this is just this week. This is this week. This is The Economist. It's fairly well respected in their opinions. But the thing is, I saw it way back in 1972. Because what happened in 1971, as you guys know, is President Nixon took the US dollar off the gold standard. That was August 15th, 1971. And this is where Harry and I come together. And at that point, they could print as much money as they wanted. So what's happened to America, as well as Australia and the Commonwealth countries and much of Western Europe, is instead of making money, we print money. And so now the big giant that's about to eat America is entitlement programs. So you look at what's happening in our academic system for our students, let's say 18 to 24, their number one debt is student loans. I think it's $16 trillion. We're putting our kids, our brightest and best who go to college, and they're not the rich kids, they're the poor kids, because a lot of poor kids they don't have the money to go to school. So Obama lent them the money. And now we have whole generations of poor kids from poor families loaded with debt, just as the US economy is pushing over, I think it's $30 trillion in debt. And we just and this goes back to 1971, again, when Nixon took the dollar off the gold standard, our debt is that high. If they raise interest rates, let's say 5%, let's say it's $1 trillion, that means 1.5 trillion a year has to go to pay the debt of America. That sucks everything we produce just to pay off the banks. And that's my concern. I hope it doesn't happen, but the math ain't that hard. 30 trillion times 5%, what does that come up to? That's like you have $1 million loan, the interest is 5%, well, your payments are $50,000. You don't have to go, you don't need calculus to figure that out. So that's what happens in 71. And what Harry's calling for, and he's been fairly accurate because he's a demographics guy. And demographics means your population. Here you have my population of the United States. It's very similar to Aussie. You have a baby boom generation, and I'm a baby boomer. Trump and I are the same age. Biden's a little bit older. And then you have the millennials who are deeply in debt. So Greg, you don't have to be a math wizard to go, something's wrong here. And
I agree. There is something wrong, but for some reason, we talk about, I was speaking to Jim Rickards recently, and I said to Jim, look, what's going on? He said, look, the Great Depression's coming. I said, Jim, I'm not feeling it. I mean, living here in Australia, we're not feeling any Great Depression ahead. We're seeing real estate prices boom. The share market's having its ups and downs, but it's still going forward. Bitcoin, some of the cryptocurrencies are still humming along. Nothing's crashing. But then on the other area, there's certain parts of people out there that run businesses and shops and restaurants. They're hurting so bad. Then there's other businesses that have never done so well.
Yeah.
Yet the economy just keeps cruising along.
And the problem isn't so much the share market or the bond market or real estate market. The reason I mentioned the US dollar and President Nixon is up until 1971, the US dollar was the reserve currency of the world, which meant what happened in 1944 was the US promised, this was after World War II, the US promised the world that we would back the US dollar with gold. That stabilized the dollar. So on August 15th, 1971, when Nixon took the dollar off the gold standard, that meant the Fed could print, the Royal Australian Bank could print, Bank of England could print, everybody print, which sent this market into this boom. Now, as you know, what happens is the share market makes the rich richer, but it makes life tougher for the poor punter on the street due to inflation. And then what happens when housing prices go up, again, you screw the poor punter on the street. They can't afford a place to live.
And I got to tell you, it's white hot here.
Yeah. And, I'm just as guilty because I'm one of those guys who I bought in Rush Cutters Bay. I made a fortune there. And I bought at King's Cross. I love King's Cross and Rush Cutters. But I made it because not so much that real estate prices were going up, but the purchasing power of the dollar, the Aussie dollar, was going down. And that is a thing called inflation. And what Warren Buffett says, inflation is one of the cruelest taxes there is because it taxes the working class. And so that's why I wrote Rich Dad, Poor Dad and all this. That's my concern. Is why don't we have financial education in schools? It's quite simple.
No, it's not there. It's not there. Well, so we're not backed by gold anymore. We're backed by the printing of money.
Well, the Aussie, you guys got screwed too by the US because you guys were counting on the US dollar. So the reason I love Aussie because you guys are a resource-rich country and China loves you too. Your coal, iron, and all that. So as long as China stays strong, Aussie will do well. But China could be in serious trouble too, because they're on the same, what I call fake money program. So Harry and I agree 100%. What we don't agree on is what to do. So that's the difference. So
John,
I love gold and silver, and I own millions and millions and millions and millions in gold, and not ETFs, not fake money. I own the real coin. And I don't keep it in the US, I keep it in other places like Singapore and Switzerland, because I don't trust my government. Okay, so that's how paranoid I am about Biden and his boys.
look, the Chinese government wants to love Australia, but every time we put our hand up in support of America, they spank our bottom, by the way, because they go and just take something away from us just to give us a warning. But so it's a little bit of an interesting tightrope we walk with China right now. The printing of money. This is a serious subject.
Yes.
And I was speaking with an engineer the other day, and he said, basically, the American dollar is the dollar. The whole world is measured by the American dollar.
Right.
And it's the Americans that are the biggest printer of money.
Right.
And he's saying, perhaps what's happened to Venezuela and other currencies that got smashed by them printing money is not going to happen to America, because America's the benchmark. They can keep printing money and it won't be the same as Venezuela. Do you agree with that?
No.
You believe in that?
Well, it's because when you look historically, it's never worked. It started with the Roman Empire. They started clipping coins. And so the reason that's, when you look at a coin today, it has the serrated edges, because what happened in about 1500s, whenever the Romans were, they started shaving the silver off the edge of the coins. And so to prevent that, they put serrations along the edge of it. And so every time a nation has printed or aberrated or debauched the currency, eventually it collapses. Historically, that it's never survived. So that was Zimbabwe, and I love Zimbabwe. Going there next year, this summer. And then there's Venezuela, and there was the Weimar Republic of Germany, which brought Hitler to power. And so it's never worked so far. I like these engineers who are not finance guys to say, what happens if you put water in a gas tank while the car stops running?
Robert, you held up an article, but you didn't quite tell us what's exactly in that article. What is the fault line article? What is it?
Well, the whole Western enterprise system is coming apart along the fault lines of the US dollar. So, that's why generally I hold up gold and silver. Harry doesn't like gold and silver. He says it's going to crash. And I agree with him. It'll crash. But gold and silver, which Australia has a lot of, as long as coal and iron, it lasts. The guy named Jim Rickards is a friend of mine also. He always says, at this time in history, you want to buy things that last. So real estate does fairly well as long as you don't overpay for it or you don't subfinance it, stuff like this. So gold, I have millions in gold and silver coins. Again, I don't keep it inside the US because historically the US has confiscated it. So, I mean, if you trust Biden, good luck. It's like Trump's my friend. I trust him more than Biden. You may not like the guy, but Biden needs the money and Trump doesn't. That's a big difference.
We had Jim Rickards on as a guest a couple of times, and
He's a smart boy, isn't he?
smart guy. Yeah,
Oh my God.
he knows he knows his stuff. But
Yeah.
Jim Rickards did say that he believed that gold was going to go to 15,000.
Yep.
And in the next 3 to 5 years, but closer to 3 than 5 years. Now it's currently at 1,800 or something. Come on, is he kidding?
Well, I like his math. You know, I mean, he's calling for 2025. It should hit 15K. Now, if he does, I'll hug and kiss him. But Harry is saying it's going to go down to 400.
Yes.
And so that's my whole point to everybody watching and listening right now. You'll always have 2 points of view, you know, and that's what makes a market. Somebody said, well, it's going to go up. And somebody says it's going to come down. That's why we have markets. And so to all your listeners today, it really is important that you just listen and decide for yourself which you like. So Rickards is saying 15,000 and Harry's saying 400.
Uh-huh.
I'd rather listen to Rickards right now, but I listen to both guys. And there's a lesson I have for your viewers and listeners today is really be careful on the source of your knowledge. I'm not selling gold and silver. I'm not the Perth Mint. You know what I mean? I'm not selling that stuff. And we don't even know what the Perth Mint has it anymore. I think that was pretty funny.
Yeah.
I think they sold it for it or something. But anyway, people are playing all these games. And so what you want is somebody who is closer to the source of the knowledge. So Rickards and Dent are not close to gold and silver. I am. I started a gold mine in a place called Dalian, China. And you know why China is the biggest producer of gold today?
Why?
They took my mine.
They took your mine.
Yeah. I don't eat Chinese food anymore. So, look, that's why what the people listening to right now, the smartest you can do is listen and make your own mind up. I started a silver mine in Argentina, and it's doing very good. It's called Yamana. I'm not pumping it, but Yamana is doing very, very well because the operators are honest. Chinese are not. I mean, I'm not against the Chinese people, don't get me wrong. But the Chinese government is pretty ruthless, as you guys know.
Mm-hmm.
So my mine was called Mondoro in Dalian, China. We struck. It was $1 billion fine, millions of ounces of gold. And one day they said, thank you very much. It's called nationalization. So that's in our world, as you know, it's called your country risk. So I trust Aussie. I mean, I trust your government, but I trust you guys are pretty solid government.
Yeah.
I don't trust the Chinese government.
Mm.
And I don't trust the US government anymore. So those are all things when you're looking at financial education. First of all, is Robert Kiyosaki selling gold and silver? No, I'm not. You know, Harry Dent isn't either, Rickards isn't either. We just move our mouths. But you've got to consider the source. If I was selling gold, then be careful. And as Warren Buffett says, never ask an insurance salesman if you need more insurance. And never ask a stockbroker if you should buy more stocks, or never ask a real estate broker if real estate's a good investment. You've always got to consider the source of your knowledge.
That's right. They have their own driven interest, and that it overtakes everything. Robert, you were probably, many people kind of do make claims of seeing the big financial meltdown in 2008. Yeah. But nobody's got better vision of it than you do when you were on television maybe 3 or 5 or 6 months prior.
Yeah.
And you just called it for what it was, 100% correct. So I'm going to drill down a little bit deeply, because obviously, you know, you had some inkling that those acidic loans or whatever were going to bring the world down. And you're right, everything can't keep booming. It can't. So Robert Kiyosaki, what signs do we need to look for that will bring down the world economy? What's going to happen? Because we're not seeing anything yet.
Well, I could hug and kiss you right now because I'm ready for that question. And I'm gonna share the most complicated part of the money thing. Let me go back again. In 1971, Nixon took the dollar off the gold standard, and gold just became this. I mean, money just became this thing. So what happened in about 2007? There was a crash in what's called the repo market. So then the repo market, and then came the subprime market crash. Okay, and most people have never heard of the repo market because it's part of what's called the shadow banking system. So I have this little diagram here. I'll show you what happened. This is what just recently happened. On September 17, 2019, there was a crash in the repo market. This is part of the Federal Reserve Bank. And when I saw that, I went, oh my God, because I was writing a book at that time with a friend of mine called The Infinite Return, How You Make Money Without Money. And so when the market crashed on September 17, 2019, this time nobody heard about it. So I'm sitting there going, okay, the last time that happened in 2008, a whole, they're called credit default swaps and mortgage-backed securities. The whole derivative market came crashing down. It destroyed people all over the world. So this happened and then nothing happened. So then November, I'm sitting there waiting for something to happen. And this friend called me from Singapore and he says, hey, there's a strange thing coming out of China. It's called COVID. And I went, uh-oh. As I said, I have nothing wrong with the Chinese people. I just don't trust the Chinese. So that's what happened. So let me explain what the repo market does. So what happened on this day, interest rates inside the repo market went to 10%. That means the price of money went up. The repo market is basically, doesn't mean repossession. It means repurchase. So it's kind of like a pawn shop. So all the biggest banks in the world, they pledge their US treasuries here. And suddenly interest rates went to 10%. That meant it's called counterparty risk. People didn't trust. It's like I go to my pawn shop and I take my wedding ring, I said, I want $10 for my wedding ring. But that was like the repurchase market. The repo market was saying, well, your wedding ring isn't worth anything anymore. You need to pay us more money. So what happened when this happens, you see this here, what the Fed did, and this is all over the world, it sent money to all the biggest banks in the world to prevent the repurchase market from collapsing. So these guys here in 2019, this is it's all caught up in what's called the shadow banking system. That's what Rickards calls complexity. He says it's so complex now, people can't understand it. So they sent this money to the biggest banks, and they sent out trillions and trillions and trillions and trillions of dollars. But something just happened in April of 2021. And this is, Greg, what I'm watching today. The banks started sending the money back to what's called the reverse repo. And what the reverse repo is called, the reverse repo repurchase market. The money from the banks was going back to the Fed. And just a couple of days ago, Wells Fargo says they're cutting down all lines of credit. So what this means here is that money is coming out of the banking system. And so, Greg, I'm kind of paying, it's like watching the signs on it's like being a sailor at sea, watching the stars and the sun and the moon and other storm clouds brewing. So today, the best I can tell you is I'm watching this money flow out of the banks back to the Fed. This is their balance sheet here. It's flowing from the repo market into the reverse repo market, repurchase market of the Fed. And this is what I suspect is going to happen. If it continues, it's going to crash. The commercial banks, this is HSBC, Wells Fargo, Commonwealth Bank, and all that, they're sending the money back in. And the reason is because the Fed has what's called US Treasuries. And that's what Harry Dent loves. Harry Dent loves US Treasuries. So Harry might be right. You should ask him about this because he knows a lot more about it than I do. But it's called, what is the collateral? What is the collateral? So with me, being an old guy, I like gold and silver and I like Bitcoin. Harry likes US Treasuries.
Okay. Let's try and dumb it down a bit more. How does the man on the street see this as interrupting the domino effect that's going to bring the world down?
Well, I'm not saying that. I just think it's interesting that the Fed for last, since this happened 2019, right? And immediately thereafter COVID hit, Trump gets impeached. He gets taken out because Trump was messing with these guys.
Right.
So just like they took down Kennedy, right? They took down Trump via Silicon Valley through Facebook, to YouTube and Twitter and all that stuff. They took down the president of the United States. They had his men arrested. They arrested General Michael Flynn, Roger Stone. They arrested everybody. But Biden comes up and his son, does so much business, Hunter Biden does so much business with China. They find his laptop computer, but they say nothing. So there's something fishy going on, big time. And so when I saw this, Greg, I said, oh my God, what's going to happen next? But Harry might be the smartest guy on earth right now, because the reason they're coming out and going here is because the security they want, the collateral they want, are US Treasuries.
Mm.
I prefer gold, silver, and Bitcoin. So Harry's saying, well, your gold and silver and Bitcoin are going to go to zero. And if he's right, he's right. But Greg, that's where we're at.
Incidentally, Harry is saying that Bitcoin may take a bit of a dip, but he believes it will come back very strong. You've always
this is what happened for me was when Bitcoin hit 20K. I said, how come nobody called me? It was what, 2019 or whatever it was. So when it hit 20,000, I waited. It went down to 3,000. I went, okay, is it going? Is it going to die forever? Now this is markets. Markets always go up and down. So hit 3,000, hit 7, and then I bought at 9. So today, let's say it's at 25,000. I'm still in the money. So the lesson to all your viewers is your profit is made when you buy, not when you sell.
Mm.
So I went up to I think 40,000. And right now I'm waiting for Bitcoin to come back to 24,000 US. And I might buy again, depending what's going on in the rest of the economy. So Harry's correct, but gold and silver goes up and down too. So Records is calling for 15,000 and Harry's calling for 4,000 gold. That's a market.
Yes. Now, look, you've always had a love-hate relationship with the banks. And you made a quote last year that you said that get out of bank shares. Now, if you're in Australia and you sold your bank shares, you may have lost a little bit because they doubled in price in the past 12 months, but they've taken a bit of a hit lately. Do you still stand by that quote?
Yeah, I really don't play the stock market or share market. The reason is because after the Chinese took my gold mine, I don't trust the stock market either. So it was a painful lesson. I was a billionaire for about a year, and then the share price went to zero.
Mm.
So the rugby players have a saying about something about that. You got what, and but that's the markets up and down. So I just say to all the listeners out here, be careful who you take advice from. There's always two sides of the trade. For somebody to sell, somebody has to buy. There's no market if that doesn't happen. But everybody's got a reason for doing it. I say to my Aussie friends, if it all crashes and I have all my gold, silver, and Bitcoin, I'll be in Aussie buying your land.
Mm.
I think your land is priceless. You need water in some places, but that's all over the world.
We're working on it. Will the massive interest in Bitcoin actually hurt gold going forward?
What was that? Will it hurt?
Yeah, will the massive interest in Bitcoin hurt gold?
Well, it did. It took about $400 off the gold price about 5 months ago. When Bitcoin went way up, money came out of gold. But that's a market. I really think Bitcoin is here to stay, not because of Bitcoin, but because of blockchain, the technology there. We're now in the crypto world, So I don't know much about technology, but the guys I know who are in technology are pretty smart guys. And they, like guys like Peter Schiff hates Bitcoin. The old guys hate Bitcoin.
Jim Rickards hates Bitcoin.
Yeah, I know. So I'd rather be with the young guys right now.
I agree with you.
But what I'm saying? I just think the reason I told the story about 1971 flying in Vietnam. I flew behind enemy lines looking for gold in Vietnam.
Mm.
But that's when my generation, the boomer generation, became gold bugs.
Mm.
I think this messing with the Bitcoin is going against the Fed. See, Bitcoin is anti these guys here, the Fed.
Mm.
So the young guys, the guys in their 20s right now, they want to screw the Fed. And I agree with them. They should. So it's kind of like a rebellion going on here with the young guys. So right now, I rather side with the young guys. But at the same time, what's happening is, as you know, China and the US are going to come out with the government Bitcoin. And that's going to change the whole dynamics again. So this is what I'm saying to people. I'm probably wrong. But let's say the Federal Reserve Bank or the Royal Bank of Australia comes out with the Aussie coin, Aussie Bitcoin. The young guys who are into crypto, they don't trust these guys anyway. Mm. They're going to hate, let's say let's call it the US Fed coin. Mm. The young guys are going to pound the crap out of it because they're smarter, they're faster, they're on technology. Mm. So just like kind of Reddit and GameStop and all that, they're going to pound the Fed coin. Yeah. So I think this is my prediction, and it's probably not correct. The only way the Fed can get back control, and it's already happening, they take gold and silver and they put a chip in it so they can trace it. So Greg, you buy this coin with a chip in it, they know who bought it.
That's right.
All right. This is my prediction, but I've already seen it happening because there were so many counterfeit gold coins coming out of China. The U.S. monetary mint started putting chips in them. I don't touch those coins. I don't want my money traced.
Wow.
So this is my prediction, is that if you own gold and silver, let's say coins, the kangaroo, and there's no chip in it, it's more valuable because you can't trace it. Now, in Australia, because you guys had that Hoddle Street massacre a number of years ago and all that stuff, and you took away the guns. Well, America, what happens is Anytime when Obama comes into office, I'm going to take your guns away. They say Obama's the best gun salesman in the world, because every every U.S. guy goes out there and stocks up on guns and bullets. So right now we have guys like me with arsenals, and we can carry full automatics. I mean, just pull the trigger and just let it rip. So I have millions of rounds of ammunition. So when I was talking to people, I'd say such goofy things like gold, silver, Bitcoin, and bullets. And every socialist, what do you mean bullets and all this? But I've made more money on bullets this year than I did on anything else, because when they tried to take away the bullets I was buying for 7 cents were selling for $1.50. I made more money on bullets than I did on gold and silver. But this is what's going to happen. This is my prediction. They're going to put chips inside the bullet heads so they can trace the bullet.
You heard it here, folks.
No, that's I think things are so crazy, Greg, that it's crazy, So this is what happens. Okay, so let's say I have gold, silver, Bitcoin, and bullets that are non-traceable. How much is that worth?
Well, a lot. Okay, I want to come back to Bitcoin, because I mean, this is a currency that if it goes from 25,000 to 125,000 or 500,000, and let's face it, it could do something crazy like that.
Yeah, I agree.
It could. Now, it's already got statistics to say it goes up high, it comes down hard, but it goes up high again.
Well, it's different. When I buy real estate, I'm an investor. I've got to know what I'm buying, how much money I'm going to make. I control the fundamentals and control the technicals and control the taxes and all that stuff. That's investing. Bitcoin is speculation. Okay, gold and silver are insurance. It's the gold and silver is insurance against the stupidity of the Federal Reserve Bank printing money.
But speculation's winning.
Yeah, well, that's like anything. I remember when, that's like, remember when the .com came out back in 2000?
Yeah.
It was pets.com and all that. That was speculation. It drove the market up. The same as Robinhood, the company, they drove GameStop and all that stuff through the roof. That's all speculation. And that's mania. So that, there's booms, busts, and manias. And right now, I think we're in a mania phase. So you got to be more careful than ever before. But if the price of gold comes down, as Harry says, I'll just buy more.
Mm-hmm. Now, I'm gonna stay on Bitcoin for 1 minute.
Sure.
So, because you have on your CV that you have seen in the future, I'm going to ask you, how do you see Bitcoin tracing over the next 5 years? What's your guess?
I think 200,000.
You think Bitcoin can go to 200,000 over the next 5 years?
If, there's a lot of ifs in between there, but my basis, Greg, is 9,000. I wouldn't buy it at 200,000. That's what I'm trying to say. Your profit is made when you buy, not when you sell. So it's pure speculation right now.
Okay. What would you tell people right now to invest in?
Well, whatever you invest in, study it. Like I love property. Like right now, if real estate in Aussie crashed, I'd be there tonight. Because you always buy, it's like David Jones, right? If David Jones is selling Gucci bags for $100, and the next day they said, okay, that's going on sale for $10, everybody be rushing in, right? But if they raised the price to, let's say, a Gucci bag to $200, well, nobody would buy it. But yet when Bitcoin goes to 200,000, that's when they'll buy it. That's really stupid. So that's speculation versus investing. When I buy real estate, I can control the numbers. I control the rent, the debt, the expenses, the tenants. I control that. My business, Rich Dad, I'm making more money than ever before, but I'm in countries all over the world. So when the COVID hit, we made more money in the first 6 months than we did for the last 3 years. Because people were buying. My book is now #1 through Amazon. You know, at number 20 overall Amazon, but #1 personal finance in every country in the world.
Rich Dad, Poor Dad.
Yeah.
Yeah.
Just look it up on Amazon. I think I'm number 20 in Amazon overall. Of the millions of books, it's number 20. So I'm making a fortune selling books.
All right. Now tell me, you're writing a new book right now. It's coming out at the end of this year, correct? Are you going to give us a preview? What's going on?
It might be my last book, is what it is.
Mr. Number One, Mr. #1 in the world. We want to hear. What is it? Come on.
No. The reason I'm a little hesitant is because the book is called The Capitalist Manifesto.
Capitalist Manifesto.
Yeah. And the positioning statement of the book says, how to beat communism taught in our schools by teaching capitalism at home. So as I said to you earlier, you know, you look at it, Greg, everything I do, I don't go near the school system. You know, I don't wear a Mao outfit. You know, I don't have the hammer and sickle. I don't carry the red flag. I'm a capitalist, school systems, communist, Marxist.
I can tell from your body language, Robert, you're not telling us everything.
What's that?
You're not telling us everything, but you're
No,
you're holding back.
It's the reason I'm hesitating is because, you know, like Trump really is my friend. I don't know if you see my books with him, but he got taken down.
Yeah.
If they can take Trump down, guess what? They can take me down too. So that's why, Greg, I'm a little tongue in cheek going, I don't want to give those bastards any warning that I'm coming at them. So I'm a Marine, you know?
Yeah.
And
yeah.
Marines, I'm putting things in place right now so when they come at me, not if they come at me, I'm in position. I got my ducks in a line. We're going to fight back.
All right. So when you're going to release this book, can we put on a show wrapped around this book?
November 10th.
We can book you?
I don't know if it can book me, but November 10th is the U.S. Marine Corps birthday.
You're going to be very busy. I can see that around that time. I was trying to get in early.
I am a Marine. I fought for my freedom. And when they censor me, they take away my freedom of speech and they take away my guns. That's communism.
And do you think freedom of speech is as bad as it's ever been in America and the world?
Yeah. They took down Trump.
Hmm.
You know, that's like Kennedy got taken down too. America has a good way of handling our leaders.
Now tell me, children, I know that you have always spoken about education. You've always spoken about children. So I know deep inside of you, there's a passion that children need to be taught well.
Yeah.
And what's the #1 thing you would like taught to children across the world, but especially across Australia? What would you want to teach them?
Well, the good news is Aussie was the most receptive to Rich Dad Poor Dad.
Ah.
And what happened is Rich Dad Poor Dad got turned down in New York by the New York Times.
Mm.
Okay, so that should tell you something there.
Mm.
Okay, and then it's very simple. All I teach is what my Rich Dad taught me. Rich Dad Poor Dad is a book on accounting. That's all it is. Income statement, balance sheet, statement of cash flow, which is why I said my banker has never asked me for my report card yet. My banker just wants to see my financial statement. So and that's why I created my cash flow board games for adults and for kids. Because if you understand how a financial statement works, that's what your banker wants to see. So the reason, you know, I'm about almost $1 billion in debt right now. But the reason I can borrow so much money is because I have very strong financials.
Mm.
But the average punter goes in there, they might give them a credit card, but they won't give them any money. So when I walk into I just borrowed $160 million 2 months ago. 160 million is not Donald Trump money, but that's a lot of money, you know. But the only reason I could do that was because I could sit down with a banker and explain to him how my income was coming in. It's called fundamentals. And it was in the state of Texas also. And Texas is very, very, very capitalistic. New York, California, Hawaii, very, very communistic. So a lot has to depend upon the states and the banks and all this stuff. So, but it's really simple. Rich Dad, Poor Dad had it all. What does your banker want to see? Not your report card. Want to see your financials.
So you're encouraging young people, get out, get a master's degree, get involved in understanding accounting, understand these things, make them part of everything you do.
Correct. I mean, everybody uses money. And I like to keep my bankers happy. You know, I go in and say, I need money, this is what I'm going to do. And the average person is told to get out of debt. In America, we have whole bunches of people say live debt free and all that. Well, that's their opinion. That's their side. I like debt because after 1971, which is when Nixon took the dollar to gold standard, the US dollar became debt. So the same thing has happened in this repo market here. The issue is what's the collateral? And so Harry Dent likes treasuries. I don't like treasuries. I like property. So the reason I go into my bank is I have 160 million bucks. It was 400 apartments in a big block. So I sit down with the bank and say, this is how I'm going to do it and all this, and they give me the money. So I don't use my own money. On top of that, Greg, is that because money is debt, US dollar is debt, the US government wants us to borrow. I get tax breaks for borrowing. So Trump and I pay no taxes legally. That's financial education. The average punter out there is, they got a job, they pay taxes. Everything they do, they pay taxes. They pay taxes on their house and all that. I don't do that. And I just, and when they changed, Trump changed the tax law. So I bought my first jet, Lear 60, tax breaks. I'm a captain. And guess what? I'm making money off my Lear 60 because people rent it from me.
Well, maybe
it's a property.
Maybe the education department could come up with a curriculum which is around Rich Dad, Poor Dad and around the concept of that and have it part.
I hate to say this, they're like my poor dad, they're Marxists. And that's why I'm hesitant to talk to you. Capitalist Manifesto, I just go into each document proving they're Marxist. They say it on their documentations. Like Black Lives Matter is Marxist. They make no bones about it. We're trained Marxists. Another thing called postmodernism, which is taught in all school, it's Marxist. So that's why when Capitalist Manifesto comes out November 10th, 2021, it's how to be communism taught in our schools by teaching capitalism in our homes.
Beautiful. Well, I know you've been a wonderful teacher, teaching people how to be self-employed, how to be entrepreneurs, how to have many streams of income, how to look after yourself. In other words, you have taught people a mindset. And that's the biggest problem people have, is the mindset. If you don't have the mindset right, you can't go there. And what you're trying to do is say, you know what, you can do it. You do have the ability. Back yourself.
What you're saying is so powerful, because what schools train you to do is you raise your hand and you say, oh, teacher, tell me what to do. Give me the answer.
And you're talking to somebody who's not entrepreneurial. But the reality is you are, but nobody ever tells people, I believe in you, you can do it. No.
Well, it's even worse than that. They tell you don't make mistakes. Well, how do you learn if you don't make mistakes?
Of course, that's where you learn. You've got to get knocked down. You've got to get back up. You've got to learn to be persistent. You've got to learn to keep going, never give up.
And business is really like a rugby 15 team. That's what it's like. No. It's not a golf team. Real capitalism is a team of 15.
Yeah,
And so
exactly.
that's why, Nick Farr Jones and Ken Peasy, they're my heroes now. They're the greatest.
Robert, it's always wonderful to talk to you. I know you go so deep and we have to pull it out of you, but it's wonderful doing it. I look forward to your new book. We will wrap a show around you in November because I'd like to tell everybody about your book here in Australia, and
Okay.
so people can rush out and buy it. And so we'll get you back. So I just want to say thank you so much. This has been so interesting to chat to you, so informative.
Well, thank you.
And inspirational. Thank you.
Thank you. Good luck to you guys.
Thanks, Robert. Wow. I don't think I've heard Robert speak like that in an interview like that ever. I've watched him on YouTube, but we had him in a very phlegmatic, relaxed attitude, sense of humor, saying things I didn't expect him to say, but it's wonderful. And you heard it here live on the GoCo group. So anyway, that was fantastic. Loved every minute of it. Now, our next speaker, don't leave, because Darren Jenkins. Darren teaches people about Bitcoin. I myself have invested through Darren and his team. I couldn't be happier. Let me say something. Darren will teach you all the practical ways to apply Bitcoin, how to understand it, how to get involved. We all don't know very much about it, but we know there's something about it, and we need to know about it. So you need to take this time. It's only a short message from Darren, but you need to hear what Darren is about to say. So now, Martin North, everybody, do not leave, because 60 Minutes heard about Martin North, and they ran a full program around Martin North, his intelligence, his information on property, his information on mortgage and mortgage stress, because he's clever. Harry Dent spent a lot of time speaking with Martin on and off the camera, and Harry says to me privately, Martin's as smart as any guy I've spoken to around the world in this subject. Property at the moment is white hot. Something's not quite right there. And who else should we speak to than the man who knows so much? I've gone to a lot of trouble to get the smartest guy in Australia to share with us, why is real estate white hot? What's going on? Martin, are you there?
Well, I'm here. Can you see me and hear me?
Well, I can certainly hear you. I can't see you as yet, but I can certainly hear you. So maybe you've got to turn on your camera.
No, I'm feeding video at you.
You're feeding video.
I am, definitely. Yep.
Well,
so I wonder whether there's something.
I'll let Jono muck around with that in back plane. I'm sure you'll pop up very, very soon. Hey, Martin, something's not right in the, there you are. Something's not right in the kitchen, mate.
Yeah.
We've got property white hot. You told us back in February last year, this could be a problem looming. And here we are 18 months later, and it's gone crazy. I mean, white hot in some corridors, a sort of fear of missing out. Everybody's jumping in.
Well, yeah, maybe. Look at the data a bit more carefully, and what you'll discover is, yeah, sure, there has been some areas where property's gone very strongly. So, for example, if you've bought standalone houses in a number of different areas, then it's looking pretty good. If you've bought units in the high-rise area, around our urban ring, they're about 15 to 20% down. So the first thing to understand is that you can't talk about property in aggregate terms. You've actually got to look at it on the ground in detail, right? The second thing that happened, of course, is we had COVID. The Reserve Bank has chopped rates dramatically. That has eased affordability. The average first-time buyer today is getting a mortgage which is 15% bigger than it was a year ago, right? Oh, yeah. So what that means is that people are getting more indebted. And the other thing that happened through last year was we had a lot of original mortgage holders who paid down their mortgage, right? So we've got this weird thing going on where effectively we've got a bunch of new people coming into property with bigger debt, and we've got a lot of older people with old mortgages paying it down. So that's another thing that's going on. The third thing is interesting, of course, we've got almost no international buyers at the moment because, the Chinese market's pretty dead. The international borders are shot at the moment. But we have quite a few people coming back to Australia from a whole range of different locales, US, UK, with a lot of money in their back pocket coming back to Australia, quite often residents returning. All right? And they've been buying at the top end of the market. So what's happened is we've got a very buoyant top end of the market. We've got a very buoyant first buyer sector of the market. Guess why? Because the government, of course, threw a whole lot of money at first-time buyers, state and federal. In WA, you get $80,000 to go buy a home and loan package. But guess how much prices for home and loan packages went up by? Precisely the amount of the stimulus, right? So you're paying more to get into the market. That was about protecting construction workers. And my argument is this. Yeah, sure, the market appears buoyant, but actually this is about saving the banks, saving the construction sector. It's not necessarily making it easier for people to get into the market. And unfortunately, you mentioned mortgage stress. I still see mortgage stress. In other words, cash flow, money in, money out. And there are more people today with cash flow issues than before COVID, right? So we have not solved anything. In fact, we haven't learned anything at all. And what's interesting is that there was a very important paper that was published about a month ago by City Futures. And they basically said, you've got to understand, there's a housing elephant in the room. And the housing elephant is trampling over everybody, trampling over everything. It's being driven by government policy and it's being driven by Reserve Bank policy. But debt is very high. We might be seeing a little bit of growth at the moment, but is it really sustainable? Because on an international basis, our debt's through the roof. So I would say that, yeah, people should be really cautious, really careful about this, whilst it may appear to have been very buoyant for a short period of time. Look at the underlying areas. It's nowhere near as powerful as you might think.
Okay. Look, I know you've got some slides and some things to show us over the next 25 minutes. And look, if we've got some time, we'll throw some questions at you at the end.
Okay, cool. All right. Well, let me just fire this up. I've go there, and then I'm going to go right. Can you see that? Hopefully you can. Yep. The everything bubble, I've called this, and that's simply because what I want to start by saying that there are things that you know, there are things that you've been told, there are things that you should know. I'm not going to give financial advice, but what I'm going to say is that things are more complicated than many people are claiming at the moment. And look, the Dow dropped the Dow dropped dramatically today. Gold's, well, wobbling around, not doing much at all. Cryptos are down again. Wherever you look, we've got issues. Property, of course, is pretty much the same. Our credit growth in Australia, very strong. Owner-occupied growth, very strong at the moment. That's because of low rates that I discussed earlier on. But look at this, investment lending just moving up slightly. Business credit and personal credit not doing so well. So we've got a situation where actually here locally in other markets are being supported by credit, particularly for owner-occupied housing and for investment housing. The RBA data shows that the Reserve Bank gave the banks 187.7 billion of funds, very cheap funds. Guess what the banks did with it? They handed it back to the RBA. They've got nearly twice as much back with them at the moment, 328 billion at the central banks at the moment. So there's a problem. All this liquidity that's being created, Harry mentioned it earlier on, Robert too, all this liquidity that's been created has gone back into the RBA. It's not actually being pumped into reasonable, sensible things. It's pumped into financial assets and it's sitting at the Reserve Bank. That's a problem. And the Bank for International Settlement said there's a real problem here with rapidly rising house prices across the world, including Australia. They actually pose serious challenges to recovery. And that's the point. This isn't just an Australian thing. This is a global thing. It's basically saying there will be a need for central banks to tighten. And postponing that tightening, that normalisation, may harm the economy. Therefore, you've got to be thinking about fiscal consolidation, which is not what people want to hear. You know, all this liquidity stuff, it's got to be paid for along the way, creating financial imbalances. And also, there's a huge sensitivity to high interest rates. And that's one of the things I want to leave with you today, right? Because rates are really low at the moment. People are highly leveraged. What happens when rates go up? And they will. What about oil? Well, oil is another interesting example. OPEC, have just announced they sort of put the price up because they didn't agreement. Then they got an agreement. Now prices have come back a bit, but oil is pretty strong. Maybe that's inflationary. Maybe we'll see inflation, and that will lead rates higher as well. And then, of course, RBA, well, they said they were going to hold their rate again, where they're going to, do some stuff with the bond buying, sort of tighten it a little bit, but keep the interest rates where they are at the moment. They may not be able to do that, though. And interestingly, what happened there when their notes, I'm just going to highlight a couple of things. It said, look, this is going to be a gradual recovery. This is before the latest COVID lockdowns. We need wages growth at around 3%. Well, we've got no chance of getting that at the moment. So that's my second point. Interest rates may be going up. Wages growth ain't going anywhere. That's a problem. And also, they're going to try and control the yield curve for a bit. But how long is the question? And, they've got this bond purchasing program. They're talking about the term funding facility, as I mentioned before. They're talking about the strengthening of the housing market. But really, this is based on a froth. This is based on bubbles. Rates are going to rise. CBA said it. And in fact, other people have said it too. They've done some modelling. What happens when rates go to 4.3%? That's a question for you. When you're thinking about your mortgage, what are you assuming about what rates are going to do? CBA is saying it could be higher by 2022, right? It is time, definitely time, to consider what happens when rates rise. Don't overcommit yourself. And here's another example. Borrowers would face an variable rate of around 4.3 in 2023. And they're looking to see rates go up by 1.25%. This is an article from Domain. And interestingly, what you may not know is that the Reserve Bank in New Zealand is now expected to raise rates when? August this year. So they're already down the curve. This is not theoretical. This is going to happen. The question is just when. Now, COVID and the resurgence of COVID may put this back, but the point is it's still likely to happen. And also, if you want more interesting information to consider, just look at this. This is the latest Consumer Confidence Index, came out today. Confidence has dropped again. It actually dropped more in Adelaide and Perth. Now, there are areas where prices were meant to be really strong, also down in Sydney and Melbourne. Got to understand that this actually could have a really significant knock-on impact, and that could also cool the property market ahead as well. And, the fact of the matter is that there are people getting very twitchy about what's going on. Retail turnover was a bit weaker, not too surprising. But again, the fact is that people went on a bit of a spending splurge, thinking everything was now unlocking, and then, well, is it? We're not sure, you see now. And what about dwelling approvals? They're down as well. So you've got to be careful, more signs of easing of momentum. And so I keep saying to people, what you think is going on and what is actually going on may not be quite the same. There are some worrying signs below the surface. Another one, building risks. All those high-risk buildings with flammable cladding. There's another 75 added in Victoria. We know there's a lot in New South Wales. We also know that quite a few buildings also have cracks and things, particularly high-rise. So the high-rise sector is really struggling with that. Another factor to bear in mind, if you see cheap high-rise property, there's a reason. It's because they've probably got cracks. And then this was important too. This is another thing to think about, the psychological harm. So an article from Vancouver saying that sky-high housing prices cause psychological harm. So not only does it flow into financial pressures, but it can also flow more broadly into what happens psychologically, how people feel, particularly young people trying to get into the property market, very frustrated. And I speak to them all the time, and some people say, I really am desperate to get in, I'm going to stretch myself. And I say, well, that may be the right thing to do, but remember, incomes might be under pressure, interest rates may go up. Just be cautious. Make sure you don't overcommit yourself with debt. Not a nice, easy thing to say, but a very important thing to say for people, I think. And then just another little data point, 1 in 5 Australians still facing hardship, financial hardship. That was before the latest COVID, according to a recent survey. That's another thing to bear in mind, because I see it in my surveys too. I survey households all the time. And as I said just now, the housing elephant in the room is rampaging. And there are things that can be done, but they are mostly things at a political and policy level. And at the moment, neither the Reserve Bank nor the government wants to solve it. So we're going to see this continuing. So we have to take our own affairs into our own hands and just make sure that we've got the right degree of research and modicum and caution before we commit ourselves, because otherwise we could end up rather uncomfortably down the route of mortgage stress. And I did measure mortgage stress in June. Guess what? As I said, it's gone up again. 41.3% of households cash flow problems at the moment. Never been higher. And interestingly, that translates to more than 1.5 million households with a mortgage struggling to make those mortgage repayments with low rates at the moment. And by the way, the household debt ratio is rising again. It's still very high. We are the second or the third highest in the world. And my data shows that if you look at mortgage stress, 41.33% of households, but they vary across the states. If you look at that, Victoria's got 44% of households in difficulty. I expect New South Wales now to start rising thanks to COVID, but rental stress is also pretty horrible too, because same dynamics are going on there. Property investors are having issues too, and overall financial stress, looking at all households and their financial footprint, also suggests that we have some issues, particularly in New South Wales and in the ACT. So all I'm saying is be cautious, be careful, don't overcommit. And finally, just on our scenarios, I run our scenarios, I think I've presented them before, just in terms of some things that may happen down the track with regard to property. This is a view that I've got. We may have the RBA right, in which case we could see house prices rising another 15 to 35% from where they currently are. I think that's about a 10% chance of being correct. If we get the vaccine rollouts working and the vaccine lockdowns work, we could see small rises or maybe small falls. I give that a 45%, but I'm beginning to look at the next one, which is what I call the longer term crunch, which is that if the vaccines really don't necessarily give the protection to the variants, if we find that there are more viruses out there, if the borders are closed for longer, if the financial situation of households and businesses continue backwards because of COVID, we could see prices go a lot further down. So my point is, there are scenarios where prices go up, there are scenarios where prices go down, and the fact is that all of those are in play at the moment, and nobody can tell you precisely which way it's going to go. So it's important to be cautious. And just to say before I close, if you want to know more about my modelling, you can go to walktheworld.com.au. And if you do that, then you can see more of my modelling, my presentations, my shows that I do. I'm doing a live show this evening actually on precisely what's happening in the markets, because I want people to make better decisions. My message today is this, right? Don't be sold the high-level hype. Don't just assume that cryptos are always going to go up, or gold is going to save you, or the financial markets are always going to be the place to go. You need to do the work. You need to really understand what's going on and to make quite sure that you don't end up essentially with something which is disastrous when it goes wrong. And what I say to people is run the counterfactual. What happens if rates go up? What happens if financial markets fall? As Harry said, they're likely to fall at some point. Run the counterfactuals and just be prepared. Don't swallow the hype, just be prepared. Lay some thoughts as to what would happen if. What happens if I lose my job? What happens if interest rates rise? What happens if markets crash? What happens if property goes down? All I want is for people to take realistic decisions. I'm not a property bear, I'm not a property bull, but I am a realist. And I do believe that many people are being sold short change at the moment in trying to understand what's really going on. So it's really important to do the work, do the research. If you're buying property, make sure that you get all the information to make the right decisions on what the value is. Property doesn't always go up. There are many examples when property goes down and sideways. I can point to you examples even today where properties are lower in price than they were a year ago or even 6 months ago. So my message today is simply this: be cautious, be careful, be a bit skeptical, and do your own thinking and research and make your own decisions. Don't just swallow hook, line and sinker those high-level messages that everything's going to be fine, the Reserve Bank will save us, prices will always go higher. We are, I think, at those bounds at the moment, thanks to that liquidity printing and everything else that I've mentioned today. So I guess that's a good place to pause, Greg. I'm happy to take any questions or answer any other points if anybody would like to throw any at me.
Martin, first of all, Martin, how do everybody subscribe to you?
Okay, so you can go to the Digital Finance Analytics blog, and I'll put that one up. Whoops, let's go there. Digital Finance Analytics blog is here. If I can just find it, there you go. Yeah, Digital Finance Analytics blog. That's where you can find all of my work and subscribe there. Or you can go to my Walk the World channel on YouTube. The channel is called Walk the World, and you can subscribe there. Or if you want a specific set of information about a particular postcode, and if you want to know what's really going on the ground, I also do have this one-on-one service where I can actually spend an hour with you talking about a particular suburb, looking at my stress data, looking at the price trends. Now, again, it's not financial advice, but it is something which quite a few people have found useful. Typically, it takes a few weeks to do the work, so maybe allow 3 to 5 weeks, and there is a charge. But I found this a very powerful conversation to have with people to try and help them understand what's really going on the ground. You can't just go to the real estate portals and assume that that's the place, because a lot of the information there is partial, it's very selective. You need to understand much more about price dynamics and all those other things, and that's something that we can do at a suburb level, so that's another area. So again, you can go to the DFA blog, digitalfinanceanalytics.com blog, and there you can find the one-to-one, you can find the links to my YouTube channel, and you can find the blogs direct as well, all my research and all the posts that I make.
That is terrific. Everybody out there, go and subscribe, hook into Martin. Do not miss. We're all going to buy property again in the future. We're all going to be selling property in the future. Why not know from the guy that's done? How many years of research have you done in this area, Martin?
Well, I've been doing it in Australia since 2001, right? And before that in the UK. I've got models that go back 20 years based on all the household research. We survey households every month. That information is very, very current. It's the most current out there. It's used by banks and hedge funds and people trying to understand the market. So there's a unique data set behind what I do. And again, what I'm trying to do here, Greg, is not scare people, but I'm trying to help them make better decisions by providing a broader range of information that is generally out there from the mainstream portals.
Well, what a wonderful service. A one-on-one with you, just a fee, just like anybody has to pay a few $1,000s for whatever, and you can give them a service and say, you're going to be buying in this area, and you can give them past, present, and future histories.
Yep. Yeah, I can talk about trends back 10 years, what was going on. I can talk about units and apartments, and units, houses, and I can talk about my thoughts as to where prices may go ahead. And we can look at, the returns and the costs and all those things. And also I can tell you what the typical negotiation is. Are people paying above the asking, below the asking? All of that stuff is hidden from the the general compass.
The odds, you're a bit like a bookmaker. Look, Martin, you probably could even tell us which suburbs have the most stress.
Yep.
In mortgage. Can you tell us that?
Well, yes, I can. So let's take investor stress, right? The highest stress postcode for investor stress is Melbourne 3000 at the moment, right? So a lot of investors who bought the units in Melbourne are really struggling because, of course, there's no international visitors, there's no students, there's high vacancy rates, values have dropped, the rents have dropped. So that's a good example. Similar examples in areas of Sydney too. And if you want to talk about houses, then we could talk about Toowoomba up in Queensland. We can talk about some of the Western Sydney postcodes, but we can also talk places like Narre Warren down in Victoria, the high growth corridors, right? All of these massive estates where people bought probably off the plan or just after off the plan, big mortgages, highly leveraged, long way from anywhere. A lot of those have the highest levels of mortgages. And worryingly, Greg, the stress levels aren't going down, right? Despite the fact that everybody says the economy is bouncing back, we're seeing high levels of stress, more people closer to the edge. And whilst they're not necessarily going to default on their mortgage straight away, they've just got less disposable money. Now, there are things you can do. You can, look at your spending patterns and try and actually figure it out. But the first thing to understand is, where am I? How stressed is this particular postcode that I'm in relative to others? And again, that's data that I have.
shouldn't that tell us a lot?
It tells us a hell of a lot, and it's a very worrying story for many people, because quite often people will say, well, yeah, I know I have a few issues, but, you know, I'm sure I can survive, right? But people tend to put their head in the sand and don't actually look at their cash flows, look at what they can stop spending. And quite often they'll go to a mortgage broker, and the mortgage broker will say, well, just refinance. You know, if you're refinanced, you'll be able to be fine. But what you do is you refinance, pay off the debt, but don't change your behavior. And then 6 months, a year, 18 months, 2 years, you go precisely the same issue again. So this is about, if you really want to seriously tackle the question of how you manage debt and how you manage cash flow, you have to actually understand where you are first. Cash flows and things are really important. Secondly, make some changing decisions in terms of how you tackle it. And the third point to make is that, you know, banks are quietly saying to people, you should sell, you know, while you can, because prices are high. And quite often people don't want to hear that, but sometimes the right answer is to sell and get out, because you may be in over your head. And unfortunately, as I said earlier on, some of these pressures create not just financial pressures, but can create social pressures and family pressures too. So it really is important to try and get your finances polished, clear and understood. And quite often, about half the people I survey in my households don't even have a cash flow. They don't actually know where they stand with what's coming in, what's going out, what commits. They just sort of hope it all's going to work.
And just keep buying.
And with no growth in income, with cost of living rising, with inflation potentially taking off now, this is a dangerous time for many people.
They think capital gain will save them.
Hopefully, but then you've got to be able to sell, and where you're going to live, right? And the other point I'd make with capital gains, of course, they also get surprised, and it's also true with crypto. If you sell crypto, you've traded crypto, right? You've got capital gain to deal with as well, right? That's something else that people get caught out with a lot of these investment strategies, that they suddenly discover the tax man comes knocking on the door too. Same with property.
Yeah. Now, Martin, I know you and I both look about 40, but I can tell everybody we're older than 40. And you and I still remember the pain of the real estate crashes. Some people have never seen the bloodbath that I saw back in the 70s and 80s. I saw another bloodbath in the 90s. I know you have seen all of them.
Yep.
They still hurt me. I feel hurt, because I remember how it hurt me as a young man. I bought a block of land for $16,000.
Yep.
2 years later, it was worth $9,000.
Yep.
That was my first jump into the big world of property.
Yeah. Well, it's interesting, Greg, because I come from the UK, right? And I went through 4 crashes in the UK over the time. My worst was I lost 30% of the value of my property because I had to sell at that particular time, right? And that was simply because of the changes in rates, changes in demand. Prices can go down, right? And this is what I keep saying to people, because frankly in Australia, they still believe that property only goes up. You know, the average punter still thinks every 7 years property prices double. No, it's not true. Maybe in a few areas, but not universally true. I know so many people who've already lost money on property in Australia, certainly overseas. And that's really the point. Just, you know, it's really important that we actually have reality here, right? Because property is not all good, it's not all bad. And it's about the decisions you take and what you do that can make the difference between winning and losing, right? But don't just assume that the magic money machine funneled in through the Reserve Bank and funneled in by government is going to continue indefinitely. It may not. And so we should be thinking about, you know, what do we do in alternative scenarios? What do we do to make sure that we protect our own interests? And frankly, you can't expect the Reserve Bank to look after your property values.
Look, somebody has sent a question in, should I get involved in the auction or should I get involved in private treaty? What's your advice?
Well, so one of my observations is, and I've studied the psychology of auctions. It's quite hard to be really disciplined at an auction. If you're clearly disciplined and you know precisely what the value is and you're not going to go over it, an auction sometimes is good. But in the current environment, particularly with the lockdowns, you know, a lot of agents are very keen to settle properties prior to the auction, right? Because they don't want to have the hassle of trying to create a COVID-free auction. So actually now is a perfect time to negotiate as a private treaty. And if you've done your work and you know precisely what the true value of the property is, and you've got the data, like from my one-on-one service, to be able to prove what the value is, you're in a much stronger position. And generally, generally you'll find that in private treaty sales, you'll end up with a lower price than an equivalent auction, because of the psychology that there'll be other people wanting to sort of bid it up. And of course, the auctioneer's a master in terms of psychological manipulation, right? So my view is private treaty is often a really good way to go.
Martin, I know we've only scratched the surface with you, and we've run out of time, but just one last thing. People, how do they get hold of you again?
Yep, so they can go to the digitalfinanceanalytics.com website, where I've got a blog, or they can go to the YouTube channel, and if they search out Walk the World, all my live shows are there, all my daily updates are there. So those are the two things. Or you can look at Twitter, I'm DFA Analyst on Twitter. But if you go to the blog, DFA blog, all my contact details are there, and all of the links to the other sites are there. And finally, if you go to walktheworld.com.au, that's my peak site. So at walktheworld.com.au, you can see everything in the Walk the World universe.
Martin, thank you. And I know your Walk the World site's got a truckload of interviews with some of the heavyweights in the world. But you know what? The most impressive person who should be interviewed is you, because I know that you know so much, and everybody could just get so much from your research intelligence, because I know you're a straight shooter, and for that reason, everybody should get hold of Martin Off. Thank you once again, Martin. We look forward to having you back on the program, eh?
See ya. Thanks, guys.
Thanks for watching. If you enjoyed the video, please click on the like. Also, make sure you subscribe to the channel. And also, lastly, click on the bell so you can be kept up to date with all the information coming in from the GoCo Group. Once again, thanks for being with us, and we look forward to seeing you real soon.